All right, good morning. The purpose of this video is to introduce and explain two new accounting terms. One called permanent, the other is called temporary. Now, up until this point, you've learned that every account a business has in their chart of accounts is classified one of five ways, either as an asset, a liability, an owner's equity, a revenue, or an expense. Today, you're going to learn that those classifications are further broken down as either a permanent account or a temporary account, and you're going to understand why. Let's go ahead and get started. Now, periodically throughout this video, I'm going to ask you to pause the video and to go to your Google document and complete the tasks that I tell you to in the video on your Google document. And when you're done, you're going to come back and just pick up the video from where you left off. So to get us thinking about permanent and temporary accounts, I want you to think about permanent and temporary items that you have in your school locker. So literally, if I was to let you all leave class right now, don't do it. Angelo, I didn't tell you can do it. I want you to think, if I was to open up your locker right now, what would be 7 items I would see inside your school locker? And then classify those items as either permanent or temporary. And on the instructions on your Google document, I tell you how that works. So right now, I want you to go ahead and pause this video and complete task number 1 on your Google document. Okay, we're back. Now, all of you guys probably had different things. Let's focus on the left side of the screen right now, permanent items. Perhaps some of you guys said, I have a coffee mug in my locker. Maybe you had a Google Chromebook. Maybe you had some keys. Maybe you had a TI Inspire calculator, whatever. Those are all assets, right? You listed, they're permanent. Those were items that when the year ends, you're not going to throw out. Rather, you're going to take them home, you're going to put them in your car, you're going to put them under your bed, and then when the next school year starts, you're going to bring them back out and reuse them. Okay? Now, on the opposite, a lot of us probably had temporary items. Maybe like a paper coffee cup. Why would you hold on to this for a year? Maybe you had a notebook, pens with no ink, pencils that you know what, I'm not going to take a pencil home for the whole summer. Maybe you had your smelly, nasty PE uniforms, and when you come in next year, for the sake of all your classmates, you'll get a fresh set. Okay? You know who you are, I know who you are. All right? Those would be temporary items. Items that you're going to discard prior to the start of the school year so that you can start fresh the next year. Moving forward, okay? Garbage cans. Come mid-May, it's going to come for my seniors, it's going to come a lot faster than you expect. Enjoy the year, it flies by. The custodial staff come mid-May, as we all know, are going to place all these recycling bins and garbage cans all over the school. The north side of the school, the south side, floor 2, floor 1. Okay? Pause the video, complete task number 2, and answer those 2 questions. What's up with all the cans? And what are the consequences to the school if they didn't put the cans in the hallway? Pause video, complete task 2, come back to video. All right, we're back, we're live. Okay, why do they do that? Because I've seen some of your lockers. Angelo, I've seen yours. Yours is probably worse than in these pictures, okay? In order to prevent a huge mess like the picture shows, and in order to dump out all the unneeded clutter each locker has, the custodial staff comes by with those garbage cans. Okay, they try to encourage you, hey, you know what, all these temporary items, my Gatorade bottles, my smelly PE uniforms, candy wrappers, since I'm not taking them home, most of you guys probably would have just left them in your locker. I'm out of here, see you later, school's out for the summer. Instead, the garbage cans are there, you take all that temporary stuff, all that garbage, and you toss it out. Why? To get the lockers ready for the next start of the school year and for the next students. All my seniors, all my 400 seniors in this school that are about to graduate. But your lockers are going to be used by somebody new next year. We need to get these lockers cleaned for that new student to come in. We need to get the school ready to begin the next school year. So all those temporary items got to get thrown out. The continuous items, they're at home, right? You're bringing those back. The calculator, your shoes, your nice coffee mug, whatever. Similarly, businesses have permanent and businesses have temporary items, okay? Here's what they are. Left side, permanent accounts are also known as real accounts. You need to know both names. Think of the accounting equation. Assets, liabilities, owner's equity, those are permanent. They're continuous. The businesses are going to use these from one accounting period to the next. So take a look at the first picture, UPS's delivery truck. Okay, what can Brown do for you? That's their slogan, right? Their delivery truck right there probably cost, that truck's probably $25,000, right? When the year 2011 ends, they're not going to all of a sudden just throw out that truck and then get a new one. They're going to use that truck for the year 2011, 2012, 2013, 2014. They're going to bang that truck into the ground to get as much money as they can out of that truck. Take a look at liabilities. If they owe Chase Bank $50,000 at the end of 2011, okay, they can't just dump that out when 2012 starts. That debt that they owe Chase, their creditor, is continuous. They owe it from 2011 to 2012 until they pay it off. Now, on the flip side, if you look at the right side, temporary accounts are also known as nominal. Nominal means it exists only in name. Okay? Revenue, expenses, and withdrawals exist only in name. You can't touch them. These are temporary accounts. When 2011 ends, that revenue balance is going to get reset to zero. That way we can track how much revenue we make in 2012. When 2012 ends, that revenue balance is going to get set to zero. That way we can track how much revenue we generated in 2013. They're temporary. They exist for only one period. They're not continuous. You're not going to reuse it. Okay, let's look at the definitions. Left side, permanent. Accounts used in business where the balances are carried forward from one accounting year to the next. Let's take a look at what this appears in live or real form. Let's look at Under Armour's balance sheet. Okay, again, definition, permanent accounts. Balances that are carried forward from one year to the next. Let's look at cash right here. Second line. In the year 2009, Under Armour had 180, let's round up, $188 million in their bank account. When the start of 2010 begins, they're also going to have 188. Now, throughout that year, it looks like they gained money. So at the end of 2010, they had roughly $204 million. When 2011 begins, they're also going to have $204 million. Now, it looks like during that year, their cash balance went down. It's continuous. It carries forward from one year to the next year. Okay? Now, temporary accounts are not continuous. These are accounts used in business where the balances start new each period. Okay, kind of like the football team's record. Okay, what did we end this season at? 7-3 or 6-4. Next year, when the season starts, we're not going to start at 6-4. We're going to start at 0-0. So that way, we can compare how we did in the year 2013 to the year 2012 to the year 2011. Same thing in temporary accounts. This time, if we go to their income statement and we look at Under Armour's income or expenses, let's just look at revenue. We can see the total amount of money they made in 2009, 2010, and 2011. Why? Because it's temporary. At the end of each year, these balances get set to zero, starting fresh from scratch, so we can easily see how we did and how we did compared to our peers throughout different periods of time. Okay, next slide. Example, left side, permanent account. At the end of 2011, Mr. P's Pizza had $20,000 cash. Okay, so on January 1st of 2012, guess what? I still have $20,000 cash. It doesn't change. It's continuous. That's a permanent account. Temporary. At the end of 2011, Mr. P's Pizza sold $225,000 total dollars of pizza. On January 1st of 2012, guess what? I sold zero. That balance is now zero. Now I can compare how I did in 2012 to 2011. Another example. At the end of the year 2011, December 31st, I had debt to Chase Bank, one of my creditors, of $50,000. When I wake up the next day on January 1st, I can't just say, see you later, Chase Bank, I'm packing bags, I'm leaving town, I'm going to Hawaii, I don't have to pay you the money. It doesn't work like that. This is a permanent account. It's real. It's continuous. Whatever I owed them at the end of 2011 is what I still owe them in 2012 until it's paid off. Flip side, temporary accounts. At the end of 2011, the total amount of money Mr. P's Pizza spent on rent throughout the whole year was $105,000. When 2012 begins, that account balance, rent expense, is zero. This way, at the end of 2012, I can compare what I spent on rent to the end of 2011. And if it went up, I could say, you know what? Maybe it's time for me to find a cheaper storefront to have my business. I'm paying too much in rent. That's temporary. Okay, so what I want you to do right now, well, actually, before you do that, here's two more tricks. One I learned from an old accounting professor, and I think the other one I just thought of while driving home. The first trick is RED. If you can remember the word RED, the acronym, R stands for revenue, E expenses. In the old days, accounting textbooks referred to withdrawals as drawing. These three accounts in business are the temporary accounts, the ones that get discarded or only used for one period. Revenue, expenses, withdrawals. If you can't remember RED, think of ice. If I was to put an ice cube in the middle of the classroom right now, 30 minutes later, the ice would melt. It's temporary. Ice is not permanent. So if you can remember ice as temporary, you can remember the I in ice as income, which is revenue, and the E in ice as expenses. Ice melts, income and expenses also kind of melt because they're temporary. They're only used for one accounting period. Go ahead and pause the video, Complete task number 3. All right, we're back. We're live. Last thing, recap. This is just a visual slide. Temporary accounts must be reset in order to accurately compare how a business is doing in the red accounts, revenue, expenses, and withdrawals. So again, I can see, all right, how much money did I make in 2010? Now, how much did I make in 2011? How much did I make in 2012? Because I reset my revenue accounts each year to 0, I only use them for one period, I can do that. How much money did we spend on advertising in 2010? How much did we spend on advertising in 2011 and 2012? Because that's an expense. It's temporary. It gets reset to 0. It's only used one period. I can easily compare how I did there. Now, flip side, permanent accounts. They're real. They have to be carried forward from one year to the next year. Okay? So in 2010, if I ended the year with $50,000 cash, when I start the year 2011, I have $50,000 cash. Now in this case, throughout the year 2011, it looks like my cash account balance went down. Regardless, when 2011 ends, I had 40 grand cash. When 2012 starts, I have 40 grand cash. Now throughout 2012, it looks like this balance went down again. So you can see over a period of time, my cash balance is slowly going down. That's not good for the business. Okay, I would not see that without carrying these balances forward from one year to the next. They're permanent. Last thing I want you to do is to complete task number 4.